back, Wall Street survivors. Levi here, and today we are one step closer to finishing the Survivor 101 series. And that means you're one step closer to finishing the foundation of your investing skills. The concept we're talking about today has been mentioned in a lot of the previous videos, but it definitely deserves its own video to explain further. Go check out some of the previous videos on the Wall Street Survivor channel. But now for the grand reveal of today's foundational skill, drum roll please. Dollar cost averaging. This is an investment tactic which involves investing a recurring amount of money in the same security over a set period of time. But why would an investor spread out their investment? Well, it's because this tactic allows you to decrease the risk of investing over time by mitigating the volatility of the market. Honestly, volatility is the reason why a lot of people struggle investing in the stock market. Investing in stocks is basically trying to predict the future, and nobody knows what's going to happen today, tomorrow, next week, or next year. Dollar cost averaging helps you reduce your potential risk and maximize your profits. If you remember our old friend Sue from the last videos, let's talk about her mowing business as an example of dollar cost averaging. Sue just started her lawn mowing business and now has 5 clients. Sue is trying to decide how many lawnmowers to buy to sustain the growth that she knows she has potential for in the future. A lump sum investment is similar to Sue buying 5 mowers at a time, whereas dollar cost averaging is like Sue buying 1 mower a month as her business grows. Here's the general premise around dollar cost averaging. So let's say you have $12,000. Many people would spend a long time saving up $12,000 and invest it all into the stock market at one time. But instead, dollar cost averaging would suggest that you take that $12,000 and divide it up over a period of time to put it into the market. Say you choose to invest your $12,000 over a period of a year. It would make a lot of sense if you split that money up into $1,000 a month and invest it each month for the entire year. This way, as an investor, you can adapt to the changes happening in the market each month instead of risking $12,000 all at the beginning, having no idea what's going to happen throughout the rest of the year. Basically, the concept is identify a stock that you think is worth investing over the long period and invest the same amount of money in the same set intervals over a period of time. When the stock price rises, you're buying less shares, and when it falls, you're buying more shares, and over time, this helps you even out the volatility of the market and take advantage of stocks when their prices are low. It's important to note that when using dollar cost averaging, you're most likely purchasing stock at a higher average price, but you're significantly reducing your risk over time, so it can be an awesome long-term investing strategy. Hopefully that all makes sense to you guys. As you know, the stock market has historically wavered a bit in the short term, but trended up in the long run. If you like talking investing strategy, make sure to throw us a thumbs up, comment down below on what stocks you think you'll use dollar cost averaging for, and again, make sure you're subscribed to the Wall Street Survivor channel. Till next time, survivors, catch you in the last video of our Survivor 101 series. Peace out. See you next time.